Let's talk about your money for a second. Have you ever actually stopped and done the math? You wake up, you commute, you put in your 8 hours, commute home, you're basically spending 10 hours a day working hard for your money. But what exactly is your money doing? If it's just sitting there in a standard bank account earning, maybe 1% interest? Well, then your money is essentially sleeping all day while you're working yourself to the bone. Gotta ask, is that really fair?
Now, I know you might think keeping your cash in the bank is playing it safe, right? But honestly, there is an invisible thief at work here. Right now, average inflation in the US is hovering around 3.3%, while the national average yield for a one-year fixed deposit, it's only about 1.9%. So what does that actually mean? It means your money is literally shrinking in purchasing power by 1.4% every single year. Let that sink in. Over 10 years, the actual buying power of 10 grand drops to just about $8,700. Doesn't sound quite so safe anymore, does it? Welcome to this explainer. Okay, full disclosure right up front. Today, I'm not going to teach you how to day trade or how to stare at complex charts or chase the next hot stock. Nope. Instead, we're diving into the ultimate lazy asset allocation strategy. And we're going to base this whole thing on a very realistic financial milestone, starting with just $10,000. The core concept here is incredibly simple. It's about making your money work for you instead of you constantly chasing after it.
So here's our roadmap for today. First up, we're going to wake up your money. Then we'll dive into the 3-layer allocation system, followed by automating your lazy portfolio. After that, we'll look at the sheer power of compounding, and finally, we'll wrap up by mastering the investor mindset.
All right, let's jump straight into section 1, wake up your money. We're gonna bust some deep-rooted investing myths.
Before we actually build our system, we really need to knock out 3 massive myths that hold so many people back. We already saw myth number 1, right? That saving is safe. In reality, saving guarantees a loss of purchasing power thanks to our old friend, inflation. Myth number 2, that you need a massive fortune to even get started. Not true at all. $10,000 is a fantastic starting line. Think of it kind of like going to the gym. I mean, you wouldn't refuse to work out just because you only have 10-pound dumbbells, right? You use them to build the habit and get your form down. And myth number 3, investing means spending your life staring at stressed-out charts. Look, for most of us, our time is way too valuable for that. Passive investing is basically just admitting that the broader market is smarter than you. Don't try to beat it, just join it.
So, you might be wondering, why do we focus on a $10,000 starting point? Well, because at a very realistic 6% return, that generates $600 a year. Break that down, and it averages out to an automatic $50 a month. Now, okay, $50 might not sound like a life-changing amount, but here's the kicker. It's generated while you sleep, while you binge watch Netflix, or while you're chilling on vacation. Seeing those first automatic dividends hit your account, it's honestly magical. It's exactly like watching a tiny tree you planted slowly grow, knowing it's absolutely going to bear fruit down the line.
Moving right along to section 2, the 3-layer allocation system. Think of this as your blueprint for financial peace.
Okay, here is the absolute crucial point. How exactly do we divide that initial 10 grand? We're going to split it into 3 very distinct slices. 20% goes into what we call your safety net. 60% forms your growth engine. And that final 20%, that acts as your opportunity bullets. This specific breakdown is absolutely key because it perfectly balances security, long-term growth, and the flexibility to capitalize when the market shifts.
Let's break down layer 1, the safety net. $2,000 goes straight into a high-yield checking account or maybe a short-term fixed deposit. Basically, this is your emergency fund, and it is the ultimate source of your psychological security. If your car suddenly breaks down or a pipe bursts in your kitchen, you use this cash. Investing, it's a marathon. And if you sprint too fast without keeping some cash reserves on hand, life is inevitably going to force you to sell your actual investments at a loss just to cover those emergencies. This layer, it's what keeps your pace steady.
Next up is layer 2, the growth engine. This right here is the beating heart of your portfolio. You take $6,000 and aim for long-term, steady growth. But, and this is important, you don't just drop it all in at once. You dollar-cost average by investing $1,000 a month over 6 months. And we split this cash up. 70% goes into broad total market stock ETFs, things like VT, VOO, or VTI, to capture that growth. The other 30%, that goes into stable bond ETFs. The reason is simple. Stocks give you those higher yields over time, while the bonds act as a stabilizing anchor, keeping your portfolio from taking wild, stomach-turning swings.
Finally, we have layer 3, opportunity bullets. You keep your last $2,000 as flexible cash, earning a modest 2 to 3% in something like a money market fund. Now, why would you do that? so you have dry powder ready to go, because when the broader market takes a terrifying dip, say 15% or more, you deploy this money. It literally turns crashes into exciting buying opportunities. Just as a quick example, during that massive 2022 stock market drop, the folks who had opportunity bullets bought in while everyone else was panic selling. And when the market rebounded in 2023, those targeted investments gained over 30%.
All right, Section 3, automating your lazy portfolio. This is all about setting the washing machine, so to speak.
This is exactly where we turn theory into action. We're setting your investments up exactly like starting a load of laundry and just walking away. And honestly, the execution is way easier than you might think. Step 1. Open a zero-commission online brokerage account. It takes literally 10 minutes. Step 2. Set up auto transfers. Look, human nature is inherently lazy. If you have to manually hit buy every single month, you're going to procrastinate. Make it automatic. Step 3. Pick total market ETFs to instantly eliminate decision fatigue. Step 4 is rebalancing, which we'll get to in a sec. And step 5, simply keep learning without overreacting to the daily news cycle.
Let's zoom in on step 4 for just a moment, because honestly, it sounds completely counterintuitive. Sell the winners, buy the losers. But this is actually what rebalancing means in practice. You see, if your stocks grow way faster than your bonds over a 6-month period, your portfolio gets entirely out of whack. By taking, maybe 30 minutes twice a year to sell off some of those outperforming stocks and use that money to buy more of your underperforming bonds, you're automatically forcing yourself to sell high and buy low. It's a brilliant little trick that keeps your whole system running optimally.
Section 4. The power of compounding. Because really, time is your absolute greatest asset. So if we look at historical data, a 70-30 stock-to-bond portfolio typically pulls in a real, inflation-adjusted return of about 6 to 8%. Let's be a bit conservative and calculate a 7% annualized return on your initial 10 grand. If you never touch it, in 10 years, it essentially doubles to nearly $20,000. Fast forward to 20 years, and you're looking at over $38,000. In 30 years, it becomes over $76,000. I mean, that is massive long-term growth happening simply because you left the system entirely alone to do its thing.
But hold on, here is where it gets truly mind-blowing. What if you take that initial $10,000 and you just automate an extra $200 a month into that exact same portfolio? Over those same 30 years, your total assets skyrocket to over $300,000. Let me say that again. $300,000. That is the astonishing leverage you get just by adding consistent small amounts to a totally automated system.
You know, there is a very good reason Albert Einstein famously called compound interest the 8th wonder of the world. He absolutely wasn't joking. It's the true, undeniable secret engine behind wealth building. Once you set it up, the interest literally earns interest on itself. It creates this massive snowball effect that practically does all the heavy lifting for your financial future.
Which brings us to our final part, Section 5, Mastering the Investor Mindset. The hard truth? The real enemy is you.
Yeah, it's a bit of a harsh truth to swallow. Your biggest enemy in investing is not the stock market. It's your own emotions. You are inevitably going to experience market crashes. And let's be real, logging in and looking at those paper losses feels absolutely terrible. Think back to when the pandemic hit in March 2020. Portfolios dropped over 30% in a flash. In those moments, it's so incredibly easy to panic and sell at the exact wrong time. And that, right there, is exactly why having an automated system is non-negotiable. It overrides your panic. When the market tanks, you don't even need to make a decision because your system already knows exactly what to do. There's also another crucial mindset shift we need to talk about. Please, don't stress entirely over squeezing out like an extra 1% on your investment yield. Your own human capital is actually your biggest asset. Think about it for a second. If you take all that time you saved by not staring at stock charts and instead use it to level up your professional skills, you could realistically double a $60,000 salary over time. Growing your income provides exponentially more fuel to pour into your portfolio than simply chasing marginal gains on a stock. Always invest in yourself first.
Which brings us to the final thought I want to leave you with today. What choices will you make with your newfound financial freedom? Because at the end of the day, financial management isn't really just about accumulating a giant pile of money. It's about buying the power of choice, it's about reducing that hum of daily anxiety, and actually gaining the freedom to focus on your family, your health, and your true passions. Look, you're never going to feel 100% ready to start, but the second best time to start is right now. So ask yourself, is your money going to keep sleeping tomorrow, or are you finally going to wake it up and put it to work?